The $100 bill in your wallet purchased a full cart of groceries in 1990. Today, that same $100 bill barely covers a modest dinner for two at a mid-tier restaurant in any major American city. This is not inflation. This is not a temporary economic cycle. This is a systematic, deliberate, and meticulously engineered destruction of the currency you have been conditioned to trust since birth. The Federal Reserve has created more U.S. dollars in the last 4 years than in the previous century combined. And while you are distracted by headlines about interest rate decisions and employment numbers, the purchasing power of every dollar in your savings account, your 401k, and your emergency fund has been quietly hemorrhaging value at a rate that would terrify you if you understood the mathematics. The middle class is not struggling because of poor financial decisions. The middle class is struggling because the very unit of measurement they use to store their labor, the U.S. dollar, is being diluted by design. The question is not whether you should be concerned. The question is whether you will continue to play a game where the rules are written to ensure you lose slowly enough not to notice until it's far too late. My name is Xavier. Today, I am pulling back the curtain on the most consequential wealth transfer mechanism in American history, currency devaluation. By the end of this deep dive, you will understand exactly how the dollar's decline is engineered, why traditional financial advice accelerates your losses, and most critically, how sophisticated capital allocators are repositioning their wealth into hard assets and treasury management strategies that the average American will never learn from their financial advisor. If you value high-level financial clarity over surface-level noise, you may want to join this network by subscribing. Let's begin. To understand where we are, you must first understand how we arrived at this precipice. The U.S. dollar became the world's reserve currency in 1944 through the Bretton Woods Agreement, which pegged the dollar to gold at $35 per ounce. This was the anchor. This was a constraint that prevented the government from printing money with reckless abandon. For nearly 3 decades, this system functioned because there was a real, tangible asset backing every dollar in circulation. Then, in 1971, President Nixon made a decision that would permanently alter the trajectory of American wealth creation. He severed the dollar's connection to gold, transforming the United States currency from a certificate of store value into what economists call a fiat currency, money backed by nothing more than collective belief and government decree. This single decision unlocked the Pandora's box of monetary policy tools that the Federal Reserve has wielded with increasing aggression ever since. The moment the gold standard collapsed, the concept of currency devaluation shifted from a theoretical risk to an operational certainty. You were simply never meant to understand mechanics. Consider the mathematics that your high school economics class conveniently omitted. When the Federal Reserve engages in quantitative easing, a euphemism for creating new money from nothing, they are not generating wealth. They are redistributing it. Every new dollar created dilutes the value of every existing dollar in circulation. This is not a controversial economic theory. This is basic supply and demand applied to money itself. Between 2008 and 2014, the Federal Reserve's balance sheet expanded from under $1 trillion to over $4 trillion. Then, between 2020 and 2022, it exploded to nearly $9 trillion. Where did this money go? It did not flow equally to every American citizen. It flowed into financial assets, into real estate, into the balance sheets of corporations that received near-zero interest rate loans. The wealthy, who hold assets, saw their net worth multiply. The middle class, who hold cash and depend on wages, watched their purchasing power evaporate. This is not a conspiracy. This is monetary policy operating exactly as designed. The Federal Reserve operates under a dual mandate: maximize employment and maintain price stability. Yet if you examine their actions rather than their words, a different picture emerges. The Fed's true function is debt monetization, allowing the federal government to spend beyond its means by creating new currency to purchase treasury bonds. The national debt has surpassed $34 trillion, a figure so large it has become meaningless to the average person. What is not meaningless is the mechanism required to service this debt. The government cannot raise taxes enough to cover its obligations without triggering political revolt. It cannot cut spending without dismantling programs that millions depend upon. The only remaining option is inflation, deliberately reducing the real value of the debt by reducing the purchasing power of the currency in which that debt is denominated. Your savings are collateral for government spending. Every dollar you have worked for, saved, and set aside for your future is being used as a pressure release valve for fiscal irresponsibility you never consented to. And here is the uncomfortable question. What exactly is your plan to protect yourself from a policy that operates continuously, silently, and with the full institutional backing of the most powerful financial system on earth? The traditional financial advice you have been fed since your first job is not merely inadequate. It is adversarial to your interests under a devaluing currency regime. You are told to save money in a bank account where you earn 1 or 2% interest while inflation runs at 6, 8, or 10% annually. You are told to maximize your 401k contributions, locking your capital into a vehicle you cannot access without penalties until you reach retirement age, denominated entirely in the same dollars that are being systematically destroyed. You are told that a diversified portfolio of stocks and bonds will protect you. Yet this advice ignores that both stocks and bonds are priced in dollars and regulated by a system that benefits from your ignorance. The financial services industry profits from your participation in these structures. Your employer receives tax benefits from offering them. The government benefits from decades of deferred taxation that allows them to capture your gains in future dollars that will be worth less than the dollars you contributed. Everyone in this equation wins except you, and you have been so thoroughly conditioned to believe in these systems that questioning them feels like financial heresy. Let me introduce you to a concept that will reframe how you view every financial decision from this moment forward. Real returns versus nominal returns. Your 401k statement shows you made 8% this year. Your financial advisor congratulates you. You feel successful. But if inflation ran at 6% during that same period, your real return, the actual increase in purchasing power, was only 2%. And this does not account for the fees embedded in your funds, the advisory fees you pay annually, or the taxes you will owe when you eventually withdraw. When you calculate the true after-inflation, after-fee, after-tax return on your retirement account, the numbers become sobering. Many Americans are losing purchasing power inside the very vehicles they believe are building their wealth. The game is rigged at a foundational level, and the rigging is hidden behind complexity that the average person lacks the time or training to unravel. This is not accidental. Complexity is a mechanism that prevents you from asking dangerous questions. So, how do the sophisticated allocators, the family offices, the ultra-high net worth individuals, the institutional investors who actually understand monetary policy, position their capital? They practice what Treasury management professionals call liability matching and purchasing power preservation. They recognize that holding excess cash in dollars is not safety. It is slow-motion wealth destruction. They allocate heavily into hard assets, tangible, scarce, real-world stores of value that cannot be created by central bank policy. They think in terms of asymmetric upside. What can I own that has limited downside but potentially exponential upside if the current monetary system faces stress? They are not predicting the death of the dollar tomorrow. They are positioning for the high probability scenario that the dollar's purchasing power continues its century-long decline, with periodic accelerations during crisis events. Hard assets form the cornerstone of any serious inflation hedge strategy. Real estate, physical gold and silver, productive farmland, energy infrastructure, rare commodities. These assets share a common characteristic that separates them from financial instruments. They cannot be printed. They cannot be diluted by Federal Reserve policy, and they maintain utility regardless of what happens to the currency used to price them. Real estate in particular offers Americans a powerful asymmetric position. You can acquire real property using borrowed dollars that will be worth less when you repay them, while the asset itself tends to appreciate in nominal terms as the currency depreciates. This is not speculation. This is leverage applied to the same monetary dynamic that is destroying your savings. The wealthy understand that debt denominated in a devaluing currency is not a burden. It is a tool for wealth transfer from creditors to debtors. The same Federal Reserve policy that punishes savers rewards strategic borrowers. This is why corporations hoard cheap debt, and the middle class is taught to avoid it. The game favors those who understand mechanics of monetary expansion. Gold deserves particular attention in any discussion of currency devaluation hedging. For 5,000 years of human civilization, Gold has functioned as the ultimate store of value. It cannot be created by governments. Its supply increases by approximately 1.5% annually through mining, roughly matching population growth. Every fiat currency in history has eventually failed, while gold has maintained its purchasing power across millennia. In 1971, when Nixon closed the gold window, gold traded at $35 per ounce. Today, it trades above $2,300 per ounce. This is not gold becoming more valuable. This is the dollar becoming worth less. Gold is a constant. The dollar is a variable. When central banks themselves, the institutions that create fiat currency, are accumulating physical gold at record rates, they are telling you something through their actions that contradicts everything they say publicly. Follow the behavior, not the narrative. But hard assets alone do not constitute a complete treasury management strategy. You must also consider the concept of capital flight and geographic diversification of your wealth. The U.S. tax code, administered by the IRS, is designed to keep American capital within American jurisdiction. There are reporting requirements, exit taxes, and complex regulations surrounding foreign accounts and investments. Yet the ultra-wealthy maintain holdings across multiple jurisdictions, multiple currencies, and multiple asset classes precisely because they understand concentration risk at a level the average American never considers. Holding 100% of your net worth in dollar-denominated assets within U.S. jurisdiction is not patriotic. It is naive. It assumes that the same government printing money to devalue your savings will always act in your best interest. History teaches us that governments in fiscal distress eventually take increasingly desperate measures. Capital controls, wealth taxes, retirement account nationalization, currency redenomination. These are not apocalyptic fantasies. These are documented events that have occurred in developed nations within our lifetimes. Argentina, Greece, Cyprus. Citizens of these countries believed their banking systems and currencies were stable until they were not. The prudent allocator does not predict which crisis will occur. The prudent allocator positions for optionality across multiple scenarios. Consider what I call the tax arbitrage dimension of hard asset allocation. The U.S. tax code, while complex, contains asymmetries that favor certain asset classes and holding strategies. Long-term capital gains on assets held over 1 year are taxed at preferential rates compared to ordinary income. Certain real estate investments allow depreciation deductions that can offset income while the asset appreciates in value. Opportunity zones provide capital gains deferral and reduction for investments in designated areas. A Roth IRA, funded with after-tax dollars, allows qualified withdrawals to be taken tax-free. Meaning if you hold appreciating hard assets within this vehicle, the gains compound without taxation. These are not loopholes. They are intentional policy tools designed to incentivize certain behaviors. The question is whether you are sophisticated enough to use them, or whether you'll continue maximizing your traditional 401k while wealthy Americans utilize strategies your HR department never mentioned. The concept of opportunity cost becomes especially relevant when evaluating your current asset allocation. Every dollar sitting in a savings account earning 1% while inflation runs at 5% is not merely losing purchasing power. It is forfeiting the compound growth that dollar could have generated in an appreciating hard asset over the same period. Over a 20-year horizon, this difference is not marginal. It is the difference between financial independence and perpetual dependency on active income, the hedonic treadmill that keeps Americans consuming and spending rather than accumulating productive assets is not merely a psychological phenomenon. It is reinforced by a monetary system that punishes saving and rewards spending. When your money loses value over time, the rational response is to convert it into goods and experiences immediately rather than defer consumption. This keeps the economy spinning and keeps the average American exactly where the system needs them, working, consuming, and never accumulating enough capital to exit the game. Let me address a question that may be forming in your mind. Is this not overly pessimistic? Is the dollar not still the world's reserve currency? Are there not billions of people who would trade anything to hold U.S. dollars? Yes, and this is precisely why the decline happens slowly rather than catastrophically. The dollar's reserve status allows the Federal Reserve latitude that other central banks do not possess. Global demand for dollars to settle international trade, to hold as foreign exchange reserves, to denominate commodities like oil, create a floor beneath the currency that delays the reckoning. But this privilege is not permanent. China, Russia, Saudi Arabia, Brazil, and dozens of other nations are actively constructing alternative payment systems and trading relationships that bypass the dollar. The BRICS nations are exploring a shared currency. Central bank digital currencies are being developed that could fundamentally alter how international settlements occur. The petrodollar system that has anchored demand for U.S. currency since the 1970s is under pressure from multiple directions. None of this means the dollar will collapse tomorrow. All of it means that the direction of travel is toward diminished dollar dominance, which translates directly into diminished purchasing power for those holding dollar-denominated assets. The sophisticated response to this environment is not panic. It is strategic repositioning. Begin by calculating your true net worth in terms of purchasing power rather than nominal dollars. How many months of living expenses could your current savings sustain if inflation continues at historical averages? How much of your wealth is locked in vehicles you cannot access without penalties? How concentrated is your exposure to dollar-denominated U.S. jurisdictional assets? These calculations often reveal vulnerabilities that the traditional financial planning process obscures. Next, establish a systematic allocation toward hard assets. This does not require abandoning your 401k or making dramatic changes overnight. It means directing incremental capital into real estate, precious metals, commodities, or other tangible stores of value with each paycheck. It means utilizing tax-advantaged vehicles like self-directed IRAs that allow alternative asset holdings. It means educating yourself on the mechanics of debt leverage in a devaluing currency environment. Perhaps most importantly, it means changing how you think about money itself. The dollar is not wealth. The dollar is a medium of exchange, a tool for transactions that is being systematically debased by its issuer. Wealth is productive assets, skills, relationships, and stores of value that maintain purchasing power across time. The confusion between money and wealth is what keeps the middle class trapped. They accumulate dollars while the wealthy accumulate assets. They save money while the wealthy deploy capital. They think in terms of how much money they have while the wealthy think in terms of what their capital produces. This is not merely a difference in scale. It is a fundamental difference in financial philosophy. And until you make this conceptual shift, you will continue losing a game you did not know you were playing. The Federal Reserve will not change course. The incentives embedded in the political system make continued deficit spending and debt monetization inevitable. The question is not whether inflation will persist. The question is whether you will be positioned among those who benefit from asset appreciation or those who suffer from purchasing power erosion. This is not about predicting specific outcomes. This is about understanding probabilities and positioning accordingly. Hard assets have outperformed cash holdings across every major inflationary period in American history. Treasury management strategies that match liabilities with appreciating assets have protected generational wealth through currency crises, wars, and economic depressions. The knowledge exists. The strategies are documented. The only question is whether you will implement them or whether you will continue outsourcing your financial future to a system that profits from your ignorance. The death of the dollar is not a single event. It is a process. It has been unfolding since 1971, and it will continue unfolding for decades to come. Those who understand this process can position themselves on the winning side of the greatest wealth transfer in human history. Those who do not will watch their savings evaporate, their retirement plans fall short, and their children inherit a diminished financial legacy. The choice is not between optimism and pessimism. The choice is between sophistication and naivety, between strategic action and passive acceptance. You now understand more about monetary policy, currency devaluation, and hard asset allocation than 95% of Americans ever will. The question is what you will do with this understanding. Will you return to the comfortable illusions of traditional financial advice, or will you begin the work of protecting and growing your purchasing power in an environment designed to erode it? The answer will determine which side of the wealth transfer you land on. And that decision, more than any individual investment or financial product, will shape your financial future for decades to come.